Welcome to The Explainer. I'm your host, and today, with a calm, deliberate rhythm, we are going to dive into a massive tech transition and turn your AI confusion into AI confidence. We're looking at an absolute game changer in modern business, the shift to autonomous vehicles, robotaxis, and delivery tech. Let's get right into it. Before we map out the rest of our journey, I want you to consider the sheer scale of this operation. We're talking about nearly $10 billion in free cash flow projected for fiscal year 2025. $10 billion. This proves we aren't just looking at some speculative tech dream. We're looking at an absolute financial juggernaut operating on a massive global scale. Here's our quick roadmap for today's Explainer. We'll be breaking down the Uber growth engine, the shift from a driver to a driverless model, the underlying financial numbers and margins, valuation ratios, future investments, and finally, what's actually in it for you, the investor.
All right, part one. We're starting with the company's business model and growth engine that's powering everything today. Looking at this market share breakdown, the sheer dominance here is pretty revealing. What we've got is a perfectly balanced barbell strategy. They are completely dominating U.S. mobility with a whopping 72% market share. Meanwhile, delivery is scaling massively past pre-pandemic levels, holding steady at 24%. We're talking about incredible global scale, perfectly leveraged across thousands of cities. But the real glue holding all of this together? It's loyalty. This staggering membership base, surpassing 50 million Uber One members globally, now accounts for over half of all mobility and delivery gross bookings. Think about that for a second. Customers who use both services just spend significantly more. It creates a massive, recurring revenue moat.
Moving on to part two, the ultimate catalyst, the shift from a pure driver to a driverless model.
Listen, this isn't science fiction anymore. This sleek integration of hardware and software is actually the foundation of the robotaxi and delivery line of businesses for next-gen. They are leveraging their massive consumer network to act as the primary demand generation engine for the entire autonomous industry.
Now, the absolutely crucial point here is that it's not about replacing humans overnight. It is a brilliant, highly strategic hybrid approach. In this driver-to-driverless model, AI and autonomous vehicles handle peak urban density, and human drivers cover the complex, sprawling suburban routes where AVs still kind of struggle. This hybrid network maximizes fleet utilization while ensuring absolute reliability for the user. It's really the best of both worlds.
Let's ground this tech transition in reality for part three. We're digging into the financial numbers and profit growth with margin.
The big story here is efficient scale. Just look at these projected Q1 2026 growth metrics. Gross bookings are up 21%, but check out the bottom line. Adjusted EBITDA is up 33%, and non-GAAP earnings per share skyrocketed by 44%. The operating leverage here is fantastic. Earnings are growing more than twice as fast as top-line bookings. That is exactly what you want to see.
But wait, here is a contrarian call-out you need to pay attention to. Don't let the GAAP net income noise fool you. Sure, the reported net income was only $263 million for the quarter, but that was dragged way down by a $1.5 billion pre-tax headwind from paper markdowns on their equity investments. These wild accounting swings completely hide the phenomenal underlying cash flow generation happening right beneath the surface.
Which brings us to part four, valuation, an important financial ratio data. How do we actually price the future?
Tracking these end-of-year PE ratios, we actually see a historically wild ride finally finding its footing. A PE ratio stabilizing around 17.9 reflects a maturing, highly profitable business. But more importantly, it signals that the broader market might currently be underpricing the massive upside potential of this autonomous vehicle transition. As legendary valuation expert Aswath Damodaran teaches us in his IT proposition, the autonomous vehicle narrative only matters to the valuation if it actually impacts cash flow. And guess what? Uber's hybrid network is doing exactly that. By drastically altering the long-term unit economics of ride-hailing and delivery, it is a total game-changer for profitability.
Now stop and think about this second contrarian call-out, Damodaran's don't freak out proposition. The heavy capital required to build out autonomous infrastructure and secure massive global partnerships today, well, those investments are exactly what's securing exponential, highly profitable cash flows for tomorrow. You simply have to spend the money now to own the future.
That transitions us perfectly into part five, recent investment, future growth, and backlog orders. Analysts at DBS clearly see this growth engine justifying a premium multiple over its peers. They've set a target price of $105, modeling a 25.2 times EV to EBITDA multiple. This premium isn't just pulled out of thin air, it is driven by their dominant global scale and the sheer velocity of their free cash flow expansion.
Just look at this backlog of AV partnerships. It's staggering. They're working with Waymo, who are seeing a massive 30% higher utilization in hybrid markets, alongside Zoox, Rivian, Pony.ai, and even Martian Apollo for AV insurance. The time is right to start building the ultimate autonomous marketplace. They aren't building the cars themselves. They're building the massive, intelligent network that every single autonomous car will plug into.
Finally, let's crystallize this in part 6. What is in there for investor?
Distilling the modern investor essence, it really comes down to this very concise 3-step playbook. Step 1. Lock in recurring revenue and cross-platform loyalty through those 50 million Uber One members. Step 2. Deploy the highest utilization autonomous hybrid network on Earth. And Step 3. Sit back and let the operating leverage expand margins, riding an expected 42% compound annual growth rate in adjusted EBITDA.
So which leaves the ultimate question for you to ponder today. Applying patience and courage, is this the right entry to capture the next boomer in tech? Are you going to hold through the transition as the driver-to-driverless model scales globally? It's a massive, historic shift, and it's happening right now. Think about it. Thanks for joining me on this explainer, and I'll catch you in the next one.